Warm welcome to our online masterclass on reducing financial aid as a catalyst for impact investing, brought to you by the Bertha Centre for Social Innovation and Entrepreneurship. My name is Shiloba Mawela. I'm a chartered accountant and the managing partner and founder at Siamo Impact Partners, which is an impact advisory and boutique asset management business that's currently fundraising for a Siamo Impact Fund. We do have some commitments in the fund and are starting to actively deploy. I'm also the co-convener of the UCT Impact Investing in Africa course. And we're thrilled to have you all on what promises to be a very bold but necessary conversation. I'm also joined by Jason, who is a co-convener on the Impact Investing in Africa course, who will be supporting this masterclass and will also be responding to questions and answers as we continue the conversation. Jason, please briefly introduce yourself and the work you do at the Bertha Centre before we start introducing our panel.
Thanks so much, Shaluba. It's really good to be here today. I'm really excited, looking forward to this masterclass. Got amazing speakers. So also just to start off by saying thank you so much for agreeing to be a part of this and to share your expertise and contribute to it. I think I'm really looking forward to your insights. So as Shaluba mentioned, to those of you who don't know me, I'm Jason. I'm at the Bertha Centre for Social Innovation and Entrepreneurship, particularly part of the innovative finance team. And what we try to do in our team is we really want to build the impact investing ecosystem. And we do this through kind of multiple pillars and streams of work. One of them being capacity building and training, which links to the Impact Investing in Africa course, which I'm co-convening with Shaluba. Really excited about that. Really one of the flagship courses on the continent for impact investing. We also do work around research, really trying to do knowledge developments in impact investing and innovative finance. And we also work towards piloting and designing new financial instruments and mechanisms. The last thing we do is to try to be a convener, so convening different players within the ecosystem, coming together for collaboration and sharing. So that's a bit about the work we do, and really excited that we could put together this masterclass, and really excited to see what comes out of it. And do please feel free to ask questions, and we'll try our best to get all of those to the panelists. Thank you. Back over to you, Shaluba.
Thank you so much, Jason, for introducing yourself and the work you do at the Bertha Centre. I think to give context to this discussion and why we've brought together this really great panel of experts is that since January this year, I think what we've seen is global headlines of change, which have echoed a chilling reality of foreign aid no longer being guaranteed. And so this abrupt change in strategy and allocation and the subsequent termination of certain programs that serve millions of people, particularly across the continent, have left gaping holes in the developmental landscape. And so what began as a policy shift has triggered somewhat of a crisis for global impact community. And so, I think within this crucible of crisis lies an opportunity, but also responsibility for the reimagining of how we finance impact going forward. And so today's discussion is not business as usual. This masterclass is about asking uncomfortable questions, wrestling with power shifts, and looking beyond aid models towards new paradigms of solidarity, capital deployment, and the African legacy. We're joined today by a panel of leaders who are not only responding to these shifting dynamics, but are actively shaping what comes next. They represent diverse institutions, and together they'll help us interrogate the central question: if traditional aid is no longer the stabilizer it once was, what must replace it? And how do we then finance Africa's futures on our own terms? This isn't just a financing question, it's also around mindset and innovation. And so today's conversation will really explore how we transition from reacting to aid shocks to building resilience and locally driven ecosystems that can absorb, direct, and sustain capital at scale. And so we really are excited to have the panel that we have today. So what I'll do now is hand over to our exceptional panel, maybe starting with Frank Aswani from AVPA, to please introduce the work you do, specifically your role at the organization, along with the lens that you bring into this conversation at the current moment in Africa's development. So Frank, over to you for an introduction. Please take about 3 to 5 minutes to ensure that we get a good sense and understanding around the work you do. Frank, please go ahead.
Thank you, Shliba. Thank you, Jason. And thank you, everyone, for making time to be with us today. This is a really pertinent conversation at a really pertinent time for the continent. So I lead a Pan-African network of social or impact investors called AVPA. We bring together investors mobilizing and deploying grants, debt, or equity into the impact space, which is also what makes us a bit unique. You think about many networks that are either philanthropists on their own or private capital players on their own. We tend to blend these into one platform. And the reason is, if you think the backdrop of all these conversations is we're in a pivotal time on the continent where we're likely to meet only 2 of the 17 SDGs. We're facing about a $200 billion annual SDG financing target. And we have declining aid, which, by the way, has been declining for the past few years. These recent cuts have just been a bit more drastic. But if you go to our website, you will see we did a study in 2020 called the Landscape Study. And at that point in time, we'd shown a 30% decline, especially in Southern Africa, of aid. So this is nothing new and nothing surprising. And then, so we've got declining aid, we've got broke governments, and we have a rising population. So that's what I describe Africa's triple challenge: less money for more people. And so what AVPA were to try and do is to increase the flow of capital into the African impact space to help address the SDG financing gap, and recognizing that that gap is not going to be closed by philanthropy or aid capital. There just isn't enough of that. The only way we can close that gap is to bring in more private capital into this space. And if you think about the $200 billion in context, it's 11% of what's available in the Africa financial markets. It's 10% of what's available in the global foundation assets. So all the global foundations, it's about 10% of that. And it's 0.2% of what's available in the global financial markets. So when you think about it, the world of impact on Africa in particular isn't short of money. What we're short of is risk capital to de-risk social investments and crowding private capital into the impact space, because private capital is not going to come into this space because they think it's too risky, they can't make the right return. So we at AVPA play in that middle space between philanthropy and aid and private capital. So we're very much in this middle space of impact investing, where we try and leverage and advance the use of innovative financing instruments to try and crowd in more private capital into the impact space and be able to optimize for both impact and financial returns. I'll be happy to talk a bit more about that as time goes through this call.
Thank you so much, Frank, for that comprehensive introduction of the work you do at AVPA. Next up, we were scheduled to have Tom from Open Road Alliance joining us. Unfortunately, he was not able to make the conversation, but we are fortunate that Vanessa from the Open Road Alliance team is here to join us. And so, Vanessa, maybe handing over to you.
Yeah, sure. Hi, everyone. Very, very happy to be here. Thanks for the invitation, Shluba. So I'm a senior investment at Open Road. I've been with Open Road for about 2 years. And prior to that, I was with Kiva, the microfinance platform. And prior to that, I was an investment banker for about 10 years. So I've been in finance for 15 years. And I bring this underwriting credit expertise to the impact investment space, because I think it is important to really adjust the financial system to impact investing, and bringing financial expertise in how we make loans to impact investing companies really helps like unlock and de-risk. So just to give you a little bit of background on Open Road and what we do at Open Road. So Open Road is started as a philanthropic initiative in 2012. 2012, so about 13 years ago. And for about the last 5 years, we had an open road impact fund where we had about 20 million that we lent to companies that needed bridge capital. We recognized today that the systemic, the financial system is highly inefficient for impact investing companies that are looking for impact money. And what we do is really provide fast and flexible funding to nonprofits and social enterprise that are facing unexpected financial obstacles. So this is, what recently happened with, the freeze of the USAID and the withdrawal of foreign aid is a very good example of why we exist, because we recognize that as a financial obstacle that needs an urgent solution. And it is in our DNA actually to provide those fast and flexible financing to companies that need it. So I'll be happy through this conversation to illustrate how we could urgently raise a philanthropic fund over the past couple of months, and that we use these funds really to help DIV USAID grantees that needed immediate funding to cover the gap they were facing in the recent months.
Thank you so much, Vanessa. We're so pleased to have you, and thank you so much once again for joining. Vanessa will only be with us for an hour, so I think the beginning portion of the masterclass, we will focus some of our questions directed at her. And so, Vanessa, thank you once again for joining the conversation on behalf of Open Road. I do want to remind the audience that please do feel free to use the Q&A or the chat functionality within this masterclass. Introduce yourself, your organization, what you're hoping to learn or get from this conversation. But also, if you have any specific questions and answers, Jason will be helping us man the chat functionality, and then we'll definitely bring some of the questions into the conversation. So please do feel included in this conversation and do participate. And with that, I'll also be handing over to Basil, who is from Convergence Blended Partners. Basil, if you can please introduce yourself and your organization and where you're positioned in this conversation. Thanks.
Yeah, thank you, Shilba, and thank you, Jason, for ably organizing this masterclass and for inviting me and even broadly Convergence to contribute to this conversation. So I work with Convergence as a senior associate. I'm based in Nairobi and mainly sitting on the engagement side of the organization, where mainly my role is managing our relationships with various organizations who are part of our member network, and broadly describe our member network as mainly comprising of capital allocators. So you can think of them as DFIs, commercial banks, impact investors, philanthropies, and other sort of organizations that support capital allocators. So consulting firms and transaction advisors. So a bit of context in terms of how Convergence was set up as I build up to what we do specifically within this space of sustainable development. We were set up as a nonprofit during the 3rd International Conference for Financing for Development. That was in Addis Ababa about 10 years back in 2015. And we were mainly set up to focus purely on blended finance. So contextually, blended finance lends itself as a high potential, private capital mobilization approach to developing contexts where risks, and this could be real or perceived risks, can often be prohibitive to private capital allocators. And so in this scenario, then blended finance solves for this by bringing on board catalytic public and philanthropic capital, which then reduces the risks or enhances the returns to bring these transactions in line with the risk return profile of private investors. And so with that context, when we were set up basically to solve for two things more broadly aimed at building the market for blended finance vehicles. Number one is to plug the knowledge gap that exists in blended finance by collating data on blended transactions. So we have what is perhaps the largest database on blended transactions, going back about 2 decades, and we track blended transactions across various geographies, various sectors, and with that we are able to inform the market in terms of these are the transactions that have gone into a particular geography and a particular sector. And even within those specific transactions, these are the various instruments that made up the entire blended capital stack. The other thing that we do is providing market intelligence on where we see opportunities for blended transactions. And then thirdly, given where we sit within this ecosystem, is also to provide thought leadership that helps to guide the further, basically to push forward the evolution of this ecosystem. And I'll share more in terms of what we are doing on the thought leadership side later on in this conversation. And then the second thing that we do is supporting the offtake of early stage blended financial vehicles. And this we do through our grant making programs, which mainly, for the grantees, they can use them for, hiring a competent consultant to support the financial modeling, do the legal structuring, developing comprehensive impact frameworks, and so on and so forth. So ideally, the grant will not go into quote unquote the balance sheet per se, but it's mainly to be used as working capital. And to this end, we've supported a number of grantees who are doing incredible work in the continent. A good example is the Development Bank of Southern Africa's Climate Finance Facility, which was essentially set up as a green bank within the DFI to mainly fund green projects, to simplify it that way. Another grantee of ours that we've supported that's doing incredible work here in the continent is Asili Africa, which is basically enabling the flow of capital to agri-SMEs. You probably might have heard of this, data being thrown around, how significant agriculture is to the GDP of African countries. And how it employs a significant number of people. However, comparatively with other sectors, it is the sector that attracts the least amount of capital. So that's what ASELI is set up to do by providing first loss type of instruments and incentives to then enable financial intermediaries to lend to agri-SMEs. And another example of a grantee that we
Hazel, I'm gonna hold you there so you don't give up all the examples. We do have, I think, set apart 2 hours for this conversation. We are hoping it will be a 90-minute conversation, but I know there's a lot you want to share specifically around blended finance, also knowing that of the top blended finance markers globally, many of them do sit on the continent. And so we understand the passion. Do hold on. This will be a long conversation. If I can maybe pause you there so that we can get an introduction from Maggie, who sits as the Chief Innovation Officer at Save the Children International. Maggie, please go ahead and introduce yourself and the work that your organization does and your role in that organization and your voice to this conversation. Thanks, Maggie.
Thank you so much. Great to be here. Hi, everyone. Like Frank says, really, really timely opportunity to discuss this topic. So I'm genuinely excited to be here. My name's Maggie, and I'm the Chief Innovation Officer at Save the Children International. I'm just 2 months into this newly created role for Save the Children. I've lived in Rwanda for the past 5 years, leading the office here, and I'm about to move across to Nairobi in June. So that's just 4 weeks away, actually. I love living on the continent. I see so much potential in the impact investment space and blended finance space here right now, and actually for innovation in general, quite honestly. I founded and still oversee Kumwe Hub, which is headquartered in Rwanda about 3.5 years ago. Kumwe Hub is Save the Children's impact investing arm, which provides concessional finance and technical assistance to African businesses that are delivering solutions for children in the area of education, health, nutrition, protection, and climate resilience. So this can be, say, a nutrition business that we see serve a market at a lower cost base than others can, or it might be a health business that has a market-based solution to, say, child and maternal health, or an education business that serves the need in a more financially sustainable way. So we're interested in all of those types of business. And I guess the lens that I'm most interested in is what we call child lens investment, which is a term that is new, but increasingly being used by some of us in the sector. So again, particularly from a big INGO with privilege, how are we using that privilege in the right way to ensure that we are finding those child lens entrepreneurs, those social impact businesses, and getting behind them and enabling them in what they can do? And can we go first? Can we, again, to quote Frank, can we reimagine our grant capital instead as playing a de-risking role? Can we reimagine it as early stage risk capital instead? And could that perhaps inspire follow-on funding from others? And could we show local financial institutions and banks that these are good borrowers, people in the child lens investment space, that these are good people to lend to? And it doesn't need to be Save the Children running services in this new world. And arguably it should never have been Save the Children running certain services. So again, I'm really excited for this timely conversation. So I think it's time for our sector in particular to check its relevance and to adapt.
Thank you so much, Maggie, for your contribution to this really timely conversation, as you've mentioned. I'm hoping to start off with a couple of questions. We will come to the audience for Q&A so that you can feel very included in this conversation. But I think maybe to start the conversation is, we've all seen the headlines that, you know, aid is going to be dwindling across the continent. I would like to paint a context of what that physically translates to, just from a tangible perspective. One, from any examples you've seen personally, or how the impact of change in aid particularly has impacted your organization or some of the partners you see. So for example, as mentioned in my intro, we're a Gender Lens Impact Fund, and because of the changes at USAID, we had a stop order given that we had some DI funding allocation. So that's a very direct impact that we've seen organizational wise as a emerging fund manager fundraising for an impact fund on the continent. So maybe Maggie, jumping to you from Save the Children, I'll come to Frank, Vanessa, and Basil. If you can give very practical examples, because I think the headline is one thing, but I think to maybe paint the picture of what it's meant for either your organization or some really clear stories that you've heard. I think it will be great to paint the context. Meg.
Thank you so much. Yeah, so let me be really open about the fact that it has affected the sector, Save the Children being no different, right? So to paint a picture, we've taken a knock for sure. Our US office alone has lost 300 jobs. We've also embarked on a series of cost-cutting measures that are going to impact around 2,300 country office staff. We've had 6 country office closures. So whole offices closing, and then at a global level, our workforce is being reduced by, it's around 25%, so just under 400 jobs. So for sure, we've taken a knock. What I can see in terms of now going to like the trends, and some of these have been there for a while, right? But it's just that now we need to listen to them and do something about them, which I'm going to say is no bad thing. It's a genuine opportunity. So what I've seen is that there's a decisive move away from grant-based, externally driven aid into blended finance and into impact investing models that prioritize, and this is the good bit, that prioritize local ownership and sustainability. As I said, which has to be a good thing. It can't be a bad thing. We are not entitled to any one government or any one donor's money. So when we get money to do, you know, good things, we need to show real results for it. So I'd say a second thing we notice is that there is more of a move towards results-based financing as well, or outcomes-based financing to Save the Children. I know the sector as a whole has been increasingly moving towards that. I think I'll give some examples later about how we've pivoted. Let me just continue to talk about trends a bit. Yeah, so funders seeking to, more and more we're being asked to how we're going to leverage their particular funding. So how is their funding going to be catalytic? So we give concessional loans, for example, we give impact linked loans, we give technical assistance, and then that's expected to crowd in private and domestic capital as well. Again, no bad thing. Definitely more challenging for us, but you know, why not? So funders are rightly saying to us, we're not just going to give you that funding to deliver these outcomes. It's good to be outcomes based, but we're also saying that we want to see that it's catalytic to more follow-on funding and to more growth. Yeah, I think I'll stop there for now.
And thanks so much for sharing so openly, Maggie, just around the impact that it's had on your own personal organization. I think 300 jobs and 400 at a global level is quite substantial, you know, and I think it is important that we do share that context, that we're not just having these high level conversations and not speaking to the realities on the ground. Frank, maybe if I can come to you to also give a bit of that context. I think as an association, you obviously have a very ecosystem approach and lens. Curious what you're seeing from some of the members and organizations that you work with. Yeah, if we can please maybe hand over to you next, Frank. Thanks.
Is it? Hi, can you hear me, Shiluba?
We can. Thanks. Please go ahead, Frank.
Yeah, so it's been really interesting for us as ecosystem players. So our network ranges from foundations, aid agencies, right through to different who are doing grants, and then you've got people doing debt and equity, they're fund managers, DFIs, corporates and governments on the other side. And so first of all, let me just start from AVPA. We haven't been significantly affected, and I'll tell you why. We're a nonprofit, so our survival is very much dependent on getting funded by grants. So we're funded by the usual suspects, but also we generate our own revenue. So strategically, we took the decision about 5 years ago to diversify our revenue. And that, in hindsight, and we decided that in the middle of COVID, was one of the best things we could have done. So we're not as dependent on grant capital to run our operations as other organizations. So for that, we're very lucky. But you will know that we launched a $200 million catalytic fund last year in September at UNGA and then at our conference in Nairobi. So our headquarters actually in Nairobi, and we have offices in Johannesburg and Lagos. So we had two initial funders in that fund. It was SIF, the Children Investment Fund Foundation, and USAID Prosper Africa. So the USAID Prosper Africa money hadn't come in. So that's not coming. So that's what we've been affected in terms of commitments to catalyzing and seeding that catalytic fund. But we've not been too significantly affected by that withdrawal. Now, what we're seeing in our ecosystem is as follows. Amongst the grant makers, especially the foundation and staff, we found a lot of them coming to us saying, one, we're overwhelmed. There's a lot more demand for the little money that we have. How can we do more with less? How can you help us do more with less? And to that end, on one hand, it's this conversation we've been preaching about the need to do this for the last 5 years. But I think people, because there was aid coming in, there's no pressure to do anything about it. Now I can tell you every week I get 2 or 3 foundations that come to me and say, hey, Bertha, help us. What can we do? So there's huge need for now people asking themselves, we've been solving this problem. We've got gains for the past many years. How do we sustain those gains? But also, how do we keep our work relevant going forward? So a lot more openness to people wanting to learn about things like catalytic capital, things like innovative finance. Our catalytic fund is a pooled fund. So how can we pool our money together so we can do more as a collective? So the collaborative pool fund thing is growing quite a bit. And we're seeing thematic pool funds. So 3, 4 people coming to say, we want to do something in agriculture, 3, 4 people coming and say, organizations coming and say, we want to do something in education. So we're giving that umbrella for people to come and do that. And also in the context of the pool fund, they're able to take a few more risks, test innovative financing instruments, which we're helping them design and structure, because that's also a competence that's lacking in the ecosystem. Another very interesting thing is people coming to us and say, would love to do innovative finance and impact investing. We've heard of them. We just don't know where to start. And so one of the things you'll know is that AVPA, UCT, Bertha Centre, UCT, with support from MacArthur, we're going to be launching a catalytic investment training program in July. That's targeting grant-making organizations, that's foundations, family offices, governments, and aid agencies, to help them learn a bit more about catalytic investing. And the difference between catalytic investing and traditional philanthropy is that with philanthropy, if you've got $1 million, you give out $1 million, it's gone. With catalytic investing, you're asking yourself, for every dollar I'm deploying, how much am I unlocking downstream of private capital to come into my space? So how can I magnify my impact? So you've got $5, you can make it $50 of impact, not the $5 you'd have gotten out of grant. So we recognize that executive teams and boards have to go through this transition. Hence why we're launching this training program in July. If you've got anyone's got an interest, please reach out to Jason or myself. So those kind of things are basically what you're trying to do. And then with the big foundations, what we are seeing is an appetite to fund innovation now. So we can test different innovative financing structures. We're finding them coming to us to say, within your catalytic pool fund, can we test a social impact bond in a certain area? Can we test this and that? So that appetite to test innovative finance is coming across quite extensively. There's still a few things I'd like to see. I'd like to see us leverage a bit more, bring more governments into this innovative financing space, because governments are your biggest grant makers, and they're probably the biggest people suffering from this impact. How do we make them part of the solution? I'd like to see us, especially in the development space, getting a lot more comfortable with profits in development. Okay, how can we support and sustain solutions by using sort of the social enterprise model, where we generate revenue that can sustain the organization that's delivering the solution? And I want to categorize this to say the kind of profits I'm talking about are non-exploitative profits. I don't want, of course, us to go and exploit communities. But you look at companies in Kenya like M-Copper, and then those guys are providing lighting and appliances to the bottom of the pyramid, earning 50 cents a day using very creative models. So these things can be done. So I'd love to see a bit more of that. I'd love to see policy change that supports this kind of thing. So that's kind of what we're seeing in the space at the moment.
Brian, thank you so much for some of those great suggestions of how we need to think around shifts and changes that we need to see. I think even Maggie's role, for the fact that she was appointed 2 months ago and is the Chief Innovation Officer, really speaks to the importance of innovation within the space. And I think also to add, you mentioned people are asking a lot around catalytic capital, but also impact investing. The Bertha Centre for Social Innovation Entrepreneurship does have an impact investing in Africa course that is being run. It's a week in Kenya, so the end of July, and then also in Cape Town. And so for people who are keen to learn more, Jason will be sharing towards the end of this masterclass more on the impact investing in Africa course. And I think, Frank, you've been involved for many years contributing to that conversation. So always happy. If I can maybe focus on Vanessa, because we have her for about the next 20 minutes. Vanessa, I think coming back to you, Open Road stepped in during a time where the US aid freeze was implemented with a very bold response, at a time when many actors defaulted to caution. We're curious to understand how was the organization able to move with such urgency for a very necessary solution to address some of the funding gaps that we're seeing? And maybe also tell us around how capital systems need to almost evolve and what the thinking of the organization is at a Open Road perspective. So Vanessa, over to you.
Yeah, sure. I think for us, it was a perfect example of why we exist, what happened, because it is literally what we do. Our mission is to offer fast and flexible funding when there is a roadblock, a financial obstacle. So companies that we help in our normal business as usual, I may say, are companies that are facing delays in their equity round, in their grant making, because, you know, to reach the milestone, to unlock the grant funding, they need to put working capital in front of that. Otherwise, they will never be there. They will never have the milestone that will unlock the disbursement of the grant. So we give them the working capital that will unlock the milestone. If an equity round is delayed by 6 months, 8 months, then we will bridge to the equity round. So really we exist to fix the systemic issues in the financing that they are going through. So when the USAID freeze was announced, I think our CEO, Caroline Bresson, seized immediately the opportunity to find a solution, because that's literally our mission. And we already came in, during the COVID liquidity crisis, OpenRoad put in place an emergency answer to help social enterprise during that time, during that difficult time. So when everyone is pulling back funds, basically OpenRoad mission is to try to make funds flow into the system. So I think for us to come up with a flexible and a fast solution, and really it was put in place, I think, in a matter of maybe 3 or 4 weeks. That was very, very quick. Like we could raise 11 million, from private funds to allocate to grantees that had their aid frozen. I think what helped us is that we started as a philanthropic fund in 2012, and a lot of prior grant portfolio were actually already DIV and USAID grantees. So we already worked with a lot of organizations that were receiving DFC, DIV, USAID grantees. So that makes us close in relationship with them. We also have, our network that is close to USAID, to DFC. So we have a direct access, if I may say, to this person and to be partnering with them. So that helped, how we could come up with a fast solution. And I think the other thing is that we could, go to private donors that are contributing to our funds pretty quickly. And because they trust us and they know our organization, we could propose a plan for them to help. And I have to say that based on our experience and recent discussion in the philanthropic world, there are still a lot of private donors that are very, very aid-oriented that still want to contribute. Like there is a recognition, I think, across the board that foreign aid is withdrawing, but private philanthropic aid is actually there. And this is a demonstration of how private philanthropic fund can still help. So we put in place a 9 million fund in a matter of a couple of weeks. And what we did with these funds is to lend 0% loan to USAID grantees that had already completed the work and were, the payment was stuck in the system. So the impact on the ground was already there. The expenses were already made and they were just waiting for their check to come in. So we could unlock that by making 0% loan to fill the gap. Most of these loans are probably going to convert to grants because if, the USAID freeze is not, the payments are not going to come through, they are going to be converted to grants, but for now, there are 0% loans to those companies. So I think we really know from our usual business that the delays, they cause organization to enter starvation cycle, that they have to hold on hiring, to defer salaries, they have to wait to place inventory order. Everything, their growth, their impact has to be reduced right away. And we don't want that to happen. So for us, it was very important to step in and to put in place an emergency fund to help those companies. So that's what we put in place. And now, we're deploying this 11 million loan grant facility to grantees that need the money now on the ground.
And thanks so much, Vanessa, for just sharing around as an impact first investor, the flexibility, but also the innovation and the ability to move with such urgency where a crisis did arise. I'm curious, Vanessa, around what risks are we most underestimating in the current transition? Where are the danger zones, both in terms of funding, but also in terms of delivery? So keen to maybe get a sense from you. Thanks.
Sure. Maybe, from a personal standpoint, what I would like to share is that, so my job is to talk to entrepreneurs every day to try to understand their financing needs, urgent financing needs, and why they need the money. And really, that's what I do every day. And then we move them, to our pipeline and we lend them the money that they need. But what's happening now when I talk to entrepreneurs is that entrepreneurs were engaged in raising funds in equity rounds. They had investors interested in investing in their company. They had term sheet on the table, things ready to move. But when the USAID freeze and the foreign aid freeze at a larger scale, became uncertain, when all the other news came in, in terms of tariffs, of that has a big impact on those companies' business model, you know. So what we see firsthand is actually that the private funds market is becoming slower, and investors are putting a hold a little bit on what they were engaged into. And this is very dangerous because now you have companies that were, you know, engaged in raising funds in a growth trajectory, and growth means impact. So we always keep that in mind. For the company that we help, it's not about growing revenue line, it's not about growing their profits, it's about impact first. So that's very important, because when you stop those companies growing, then you stop the impact and you delay the climate and social advancement that we all want to happen. So we can see right now, I had 2 examples in companies that were in due diligence with investors, where investors said, and they've been in discussion with these investors for months and sometime a year. And the private investor said, listen, now is not a good time. We have to pause because things are a little bit too volatile. There are too many uncertainties. So we need to wait a little bit before we re-engage our conversation. So this has dramatic consequences, of course, for this company. So I wanted to share that experience, because I think it's important for everyone to be aware that there is definitely a shrinkage in the private funds market now. Hopefully it's going to be temporary. And what we need to do as, I think, a whole, like especially in the private funds market, because we are a private fund in a way. We are incorporated as a non-profit, but we'll still, you know, allocate private money to organizations that are impactful. Is this shift in how we assess the risk. The risk, you know, in finance, usually we talk about risk reward. Here it's a paradigm between risk and impact. Like, what is important is not the reward, it's not the return that we're going to have, it's the impact that we need to have. And I think most of the private funds need to rewire how they look at the risk, and risk needs to be balanced by impact, not by profit reward. And there is a lot, the impact investing ecosystem is very big. There are a lot of private funds that are impact funds, but we need more impact first funds. And I think that's the transition that we need to see, really impact first, instead of just considering impact as a nice standby, you know, return. So that's the thing. And Frank had a very good question that I think is very relevant, which is how do we more with less? And I want to add to this question, how do we do more taking more risk? Because that's what we are facing. The current environment is riskier. Private funds are going to be more at risk. So instead of withdrawing the money because it's riskier, how do we get the appetite for doing more risk? And of course, blended finance is one of the way, catalytic funds is one of the way, but we really need to focus on that, on like taking more risk from a private funds perspective.
Okay. And Vanessa, before we need to let you go, maybe just a final comment around any promising innovations. I know you've touched on a number of ideas and solutions you'd like to see in market, but any new partnerships, instruments, or leadership models that you think are worth spotlighting, or that we do need to start thinking around? So anything there, and maybe any closing remarks, because I am mindful you do need to step off. And thanks again for joining.
Yes, thank you very much. Well, I think the innovation, we're thinking every day about innovation at OpenRoad, because we really do things in a different way. We are very niche in the product that we offer. There are not a lot of bridge lenders out there. Commercial lenders are not lending to impact companies. In Africa, it's like the private debt market is very, very scarce. So as a private lender, I think the innovation comes from our ability to partner with DFIs, with philanthropic organization, of course, with grantors. Like we want to build more resilient partnership, because that's really how we're going to advance. And it's about really connecting the dots between the different actors in the ecosystem. And for us, it's about getting closer to the private investors, closer to the DFIs, closer to the grant makers, so we can really help them move their capital at a faster pace, because as a bridge lender, we'll make the advance to the companies until they can do the final disbursement. Due diligence takes longer, legal documentation takes longer. So for us, it's really about establishing like a meaningful and long-term relationship with funders, so we can bring the money faster to the companies. So that's that's really what I would like to see. It's not really an innovation, I'm conscious of that, but it's the way we need to work better all together with that. Yes.
Vanessa, yeah, I was just going to say thank you so much. And I think it was really important to have Open Road in this conversation as a demonstration that rapid strategic capital can be deployed under pressure when systems are flexible and purpose-driven. And I think really also the call to action that we do need more impact-first investors in the landscape. But I think thank you so much. We will be sharing, I think, a link to the recording. You can catch the rest of the conversations.
Yes, I will.
And I think also people can engage directly from the Open Road website if they are looking for a solution for some of their funding needs. So thank you once again for joining the conversation. It has been a pleasure to have you participate. Thank you so much.
Thank you. Bye.
And then to that, I think, thanks, Vanessa. Basil, that was a perfect introduction to bring you in. Vanessa spoke a lot around the importance of blended finance. And, you know, I think obviously convergence plays a very important role as it relates to blended finance on the continent. Keen to understand, obviously people see it as a key solution to addressing some of the funding gaps. I'm curious what's working, what's not working, and how can these models be more effective and accessible in practice?
Yeah, sure. Thanks. So we've been around for about 10 years now. And, you know, obviously over that period, we've kept track of the data and produced multiple reports around blended finance, a good number of them focused on the continent specifically. I think what we can successfully, or what we can communicate at this point, is that blended finance has successfully proven itself as a viable structuring approach, you know, in mobilizing private capital. And, you know, there's a report that we just released yesterday, actually. We call it the State of Blended Finance Report for 2025. It's an annual report that we put out every year, just looking at broader market trends and, you know, sampling key voices within the ecosystem. And so in the report, we basically point out that, you know, overall blended finance has achieved a leverage ratio of about 3.76, so just close to 4. And what this means is that for every dollar of concessional capital that, you know, has gone into a blended vehicle, it has successfully mobilized, you know, that nearly $4 of private capital. And so more broadly, you know, we can say at this point that blended finance is an effective structuring approach to mobilize private capital. There's a bit of, you know, nuances once you begin to break it down by transaction sizes. And, you know, if you're looking at transaction sizes above 100 million, then that leverage ratio goes slightly above 5. And if you're looking at transactions below 100 million, then, you know, the leverage ratio dips below 3. And so more broadly, anecdotally, what we're seeing here is that for blended finance is more effective when you're looking at solutions at scale, because, you know, going back to Frank's point around doing more with less, that's where it's possible to sort of leverage more private capital for, you know, a relatively low amount of concessional capital. And, you know, the same nuances begin to show themselves once we also break it down by sector. And so as you would perhaps expect, when we're looking at energy sector, for instance, the leverage ratio is much higher, perhaps when you compare it to a sector like healthcare or even education in that instance. And so given that we, you know, have tracked this data and we've seen the, the success that blended finance has sort of achieved in demonstrating that it's possible to mobilize private capital using concessional capital. What we are now trying to focus on as an organization, and this is going back to our thought leadership mandate, is basically guiding the market to adopt good practice blended finance approaches. And this is an initiative that's being led by our managing director, basically looking at out of the, I think right now we have tracked close to 1,400 transactions. Out of these 1,400 transactions, what are the broader archetypes that we are seeing within the data set of transactions that we've tracked so far? And what are the broader, can we create like more standardized models out of this broad subset of transaction data that we've tracked so far? And so we've come up with 12 standardization models that basically respond to various use cases where we've seen blended finance being deployed, whether it is a sort of like a government-led initiative where it's a government putting in some of its money and then structuring it in such a way that ultimately further down the line private capital is being mobilized, or private sector-led approach, and also looking at various instruments, whether debt or equity, and so on and so forth. And the reason why we are guiding the market to adopt these good practice blended finance models is because this is basically us responding to a long-standing criticism, especially from institutional capital, which I think the current data says it's close to $500 trillion, and that's like a significant pool of capital that ideally we should be tapping into the projects and investments that are being set up in developing contexts. And so the criticism from this constituency is that blended finance has become far too fragmented, and that if you look at it critically, no transaction is alike. You look at one transaction, it's different from the other, and from the other, and from the other, and so on and so forth. And so this is basically us trying to create standardized blended finance models that would broadly be similar. Doesn't matter when whether you're looking at it in Africa or in Asia or in Latin America. If you're looking at a 3-tier fund model, it would broadly be the same. So that's really where we are trying to sort of guide the market. And we've recently put out schematics and just brief descriptors on the 12 standardization models that you can find on our website. And at this point, we're basically looking for feedback from the market as well. So I'd welcome the audience in this masterclass to basically go to our website and take a look at the models that we've sort of come up with, and provide your feedback as well. We're also taking this sort of talking points to the potentially to the 4th International Conference on Financing for Development that will be happening in Sevilla at the end of June. So that's broadly, where we are in terms of trying to respond to the criticisms that we've seen from the market, and trying to create a picture of what the future for blended finance would look like.
Okay, thank you so much, Basil, for that very comprehensive outline, but also for the really impeccable work that Convergence is doing. One, by releasing the latest state of blended finance report. So just as another reminder, that is available on Convergence's website, and the team is keen and open to engagements and feedback on that report. So please do take that up. But also, I think getting a sense of the 12 standardization models and schematics that are available on your website as well. I think maybe Frank, I'll ask 2 more questions, one to Frank, one to Maggie, and then the chat it does seem like there are a lot of questions from the audience. I do want to jump to those. So Jason, maybe getting ready to start aligning some of those. I think, Frank, you published a very important piece on what a resilient, future-ready African impact investing ecosystem would look like and what types of capital must evolve to support that vision. You also spoke around the importance of the large untapped potential of domestic capital. I'm keen for you to maybe summarize some of the key insights and recommendations that you had in that article, but also how do you think about what catalytic reforms are necessary to activate the capital effectively? And yeah, I think if you can give a summary of that report, I think you had like 6 really great recommendations, which I think are very important and key for this conversation, but also thinking around how do we then tap into more local capital?
Okay.
And then Maggie, we're coming to you soon.
Okay, thanks. Thanks, Shiluba. So this is an area very close to my heart, and as we think about this conversation, let's remember this is the 3rd crisis we are facing in the last 5 years. So we've been through COVID, where we were the last ones in the queue for vaccines. Russia-Ukraine war happened, and we couldn't get food and grain, and then this has happened. Surely history will judge us very harshly if the 4th one comes by and we're not better prepared. So my article is really around thinking about how do we future-proof Africa. And you'll see our conference at the top of my backdrop here. We're having a conference in November. It's really about future-proofing the continent. We've got to fail forward. We can't be caught with our pants down next time. So I came up with a couple of high-level things. First of all, the first thing for me is if you look at our $200 billion annual SDG financing gap and put it into context, we have about $2.4 trillion sitting in what I call dormant capital assets on the continent. This is sovereign funds, insurance companies, pension funds. That money is mostly either invested out of the continent or sitting in government paper, treasury bills. It's not being put to use in the productive sector and the impact space. And I think there's an opportunity for us to see how we can bring that money more into the impact space. We know it's not easy. There's regulators who are managing pension funds and stuff like that. But it's about time to start having those conversations.
Frank, there might be a freeze. I don't know if it's just on my side. Okay, I think you're back now, Frank.
Sorry.
There was just a small delay in the audio.
No, sorry. My son is at home, and when kids are at home, you're fighting for bandwidth. So this whole issue of local capital, we really have to look at it seriously now. And the other thing to think about is what's needed for pension funds, for example. So we've got to start thinking, how differently do we communicate the problem? And I'm a big believer in saying, whenever you're playing in this space, fall in love with the problem, not your solution. Okay? Because collaboration happens at problem level, not at solution level. Fall in love with the problem. And then when it comes to scaling what works. Don't scale your solution. Okay? Don't fall in love too much with your problem that you don't see the blind spots, and you leave a very good solution that you could support the scaling of that particular solution. So in this case, we've been talking to pension funds for the longest around the fact that they need to come and invest in this impact space. And for a long time, they gave us a deaf ear. But the last 2 years, I've seen a lot more pension funds come to us and say, the reality is coming home. If the current rate of youth unemployment continues in Africa, pension funds will cease to exist in the next 15 years. Okay? For every pensioner that leaves a pension fund who they pay out, they need to recruit 20 new young people. And if the young people are not working, or if they're working, they're making such little money, pension funds have no customers. So we're seeing a couple of pension funds that are now starting to support the SME space with some of their money to be part of the job creation machinery on the continent. So never get tired. My big lesson in the last couple of years, never get tired of the problem you're trying to solve if you strongly believe that you're solving the right problem. Okay? Because eventually people will start listening. And especially if you're a bit forward thinking, you'll find that you might be a bit ahead of your time. But if you can see the problem coming and you can start creating awareness, don't stop. So that's the first thing. The second thing I brought in the article is about the evolving role of philanthropy. philanthropy has to move from, in my view, being entirely grant making. Okay, we recognize that there's some things in Africa that will always need grants, and I'm not saying dump philanthropy from what it's doing currently. Is look at how you diversify your investment thesis. So do some traditional philanthropy in sectors that need and spaces that need that your pure grants, but also start thinking of yourself as a catalytic investor, where you're using your risk appetite. What a philanthropist has that is unique is appetite for risk. Okay. Using a risk appetite to test new markets, products, and services to a point where they can be scaled by more commercial capital. And I think that is super important for us. This wedding is not going to happen without philanthropists. They're the bridesmaids. Okay, the way capital markets work, if we're going to change how capital markets work to benefit vulnerable communities, philanthropists have to lead. So that's one of the things. I think philanthropists also have to start funding market-based solutions that are generating revenue, and not just pure and non-traditional nonprofits. So if you've got a social enterprise that's offering affordable services and where the beneficiary is willing to pay and has an ability to pay, that for sure is a more sustainable solution than funding an NGO that comes to you for grants every year, year in, year out. So let's think about market-based solutions. So that issue about the evolving role of philanthropy is very important. And I've got another article I wrote specifically on that, maybe about 4 or 5 months ago. I'm happy to post it here if need be. But that's something I think we need to think about. Shiluba, you talked about changing mindsets. I think it's very important that in development, we've got to start being comfortable with some sort of profits to sustain innovation and to sustain solutions. So long as it's not exploitative, I think that's very important to make this. And then as I mentioned earlier, the fourth thing is about making sure that private sector is aware that social issues, in this case, youth unemployment as an example, is also becoming a business risk if it's not addressed. So pension funds can't just ignore this thing, the stuff happening about them. The same to FMCG companies. So we have to change how we talk to the private sector as well, and tell them this thing will come and bite you if you don't help us address this. We're in this together. So even in the way I talk about these things going forward, I don't talk about sustainable development anymore because you're quickly put in the aid philanthropy box. I talk about sustainable growth because it's both our responsibility, whether in development or private sector. Bringing in governments into this space, we've got to be very deliberate as point number 5, not to leave governments behind. They're the biggest enablers of the impact space and also the biggest catalytic investors if they think that way in any market. There's no market where governments, there's a bigger grant maker than a government. If we can think and start hoping that our governments can change to become more impact investors in their thought process, would really be useful. So for example, if part of their portfolio, if we could imagine if we could test revenue-based financing models in government tenders, we can fight corruption, as an example, and make better use of the little capital we have on the continent. And then the other thing is to make sure that the final point for me in my article was talk about the people coming from outside need to help us. They need to help us by not just supporting the initiatives that we're trying to solve for, but also enable us and enable us by building our capabilities and competencies. But in funding issues, don't just fund symptoms, fund root causes, because we've got to solve for this sustainably.
Frank, thank you so much for just sharing around that article and the time taken to sit down, really engage and reflect on what it is that the ecosystem needs. And I think an important segue is into Maggie. I think, Maggie, you occupy such an important role being Chief Innovation Officer. And so I'm curious, I think the aid freeze has revealed how fragile many organizations are. We've seen the impact of jobs lost, services paused, and lives disrupted. And so I'm keen to understand what safeguards or innovations are essential to prevent future shocks, but also how organizations such as yours adapting in this new environment. And I think really just going into more detail around the impact investing offering without compromising the mission of the organization, specifically because you guys have a child lens. If you can please speak to innovation I think innovation and pivoting into impact investing and how Save the Children as an organization has been able to make that transition and also be quite more agile in the market. Thanks, Maggie.
Brilliant. Thank you so much. I actually want to start with how do we move into impact investment without compromising mission? Because I think that's where we need to be really careful of not bandwagoning. And people are always quoting the trillions in potential impact investment capital that's out there. But really, is that the reason that INGOs should be pivoting into this space? Or might it be because there's a more impactful, a more genuinely empowering way of doing social impact? I really hope it's the latter. And we are seeing it's the latter with like our nursepreneurs that we are giving loans to open up their own clinics rather than us running the clinics. Same with early childhood development centres. Do we need to be running those, or could we give a loan to a woman to expand her business? She's earning money at the same time, but it's creating that bottom of the pyramid market that just isn't there at the moment. So when you and I want a kindergarten or a clinic for our child, we just have a whole range of options. But for a lot of markets, they either have something free that perhaps Save the Children or government might run, that they stand in a queue for 4 or 5 hours. Or they've got like a really, really expensive option that's completely outside of their ability to pay for. So how do we create hundreds and hundreds, thousands of services that are in that space of affordable but still high quality? And that's where I think we don't compromise on mission if we always have our eyes on that prize. And certainly within Kunwe Hub, we've had a 3-tier impact measurement model, right? Where when we give a loan to a business, we're looking at impact, firstly, number one, at the business level. So what is happening to that business that we've given the loan to? What's happening to their profit and their revenue? Then the second level is the community level. So these are kind of for us the numbers. So how many people are benefiting from that product or that service? How many jobs are being created? Household savings going up? But then excitingly for us to Save the Children, we're able to go into that third level, which is the child level. So I don't just want to see that there's been this many children benefiting from this product or service. I want to see how it's affected their early learning outcomes, like their literacy, their numeracy. I want to see their nutritional status has changed. Is their stunting height and weight, how's that doing? So, and then fourthly, we do talk about like an ecosystem level, but I think keeping our eyes on the prize of that third level, the child level, is really important. Otherwise, why would we be doing it, right? Why would just Save the Children be in this space? Other people could arguably be in this space. So that's the kind of, not compromising on mission. To then take the first bit about, the fact that, yeah, it did show fragility, all of the shocks, and how do we prevent those shocks in future? I'd firstly just say that actually Save the Children decided to invest in and lean into innovation well before these cuts. And despite these cuts that I referenced earlier at the start of the call in their hundreds of thousands, they did decide to invest in this role, the innovation role, because it's seen as, our business is children. And frankly, there's never been a tougher time for children right now. Just in the last decade, we've seen multiple crises that have always children have borne the brunt of those crises. And that includes the insufficient funding that's always been there, but now it's definitely made worse. All the fallout from the COVID pandemic, which is still happening, the escalating climate crisis, and then children involved in the highest number of conflicts since World War II. So it's like genuinely there's that need there still, but we acknowledge that the traditional ways of reaching those, and certainly now the traditional funding streams, are not there any longer. So then in terms of safeguarding future shocks like this, I've listed 5 things from my point of view that we need to do. The first is diversification of funding sources, which might be an obvious one, but building resilience requires moving beyond a single donor or a single aid stream even. Like I said before, we are not entitled to anybody's funding. It is really disappointing for a big government like the US to decide to deprioritize development funding so much, but we are not entitled to that, right? And we can't have a whole business model that is based on that. So this is where blended finance and revolving funds are seen, like in our ECD and health models, increasingly a key, because perhaps we can have the same outcome. We had an early study done, in fact, on one of our health initiatives that showed that traditional aid interventions were around $11 per child, whereas these new innovative finance approaches were more like $4 per child. So how do we get more impactful programming like that off the ground? Secondly is organizations like mine, we do need more flexible, emergency ready capital, because we did lack reserves, many of us, to be adaptable during the aid freeze. And if we're still going to respond to emergencies, which I think there is inevitably a big need there still, then investors and grantees in our sector need to structure capital with contingency buffers and rapid deployment mechanisms. I really appreciate funders like Innovation Norway who want us to give the problem to them and show that we've got a good understanding of the problem, but not our approach to fixing it immediately, and not that we're going to jump into a 3-year project plan that's going to stick to this particular log frame, because that's never going to be effective at all, given the way that the world moves, and it never was. So that kind of flexible funding, I think, is great and leads to really, really impactful programming. Thirdly, local capacity and ownership. So embedding genuine business skills, governance skills, financial management into local partners, that can ensure continuity when external funding falters, right? And we've been saying this for a while, we've known this for a while, but we're not very good at doing it. We're not very good at relinquishing power. We give bits and pieces, but we don't want to totally override the world order, as it's been for the aid sector, but that is what needs to happen. And we actually see the current funding freezes as an opportunity to do this well, perhaps for the first time. Fourthly, data-driven impact measurement. It's so important that we've got robust, disaggregated data. That is essential for demonstrating the value that we're having and also attracting new forms of capital. So a lot of people say if you can't measure it, it didn't happen, which, you know, I think is fair. And then fifthly, human-centered, co-created models. I guess this is linked to number 3, but I feel that we've thought as a sector in the past that localization, which is, you know, totally overused term, but we felt that localization is just getting local partners to deliver on our strategy on behalf of us. But now I believe we're getting excited about the idea that we could ask local groups, what are you doing and what do you want to work on? And then we build our entire strategy around supporting that. Yeah, and we've got lots of really exciting examples of where this has come out. I mentioned the ECD financing, the health financing. Another one that was completely community born and is now community led is a refugee-led daycare model, whereby working mothers came to us and said that there's no daycare, there's no kindergarten. So we have a model now that's being scaled because it worked well there, that we pay for the first 9 months of setup, training of all the staff incidentally that we get from the local community population of refugees. And then after that 9 months, the parents start paying at 10%, 20%, 30% until it's completely 100% covered by the community, and they run it with a committee themselves. And the data from that shows that on average, people, the women are earning in their small, they've got micro businesses like they're fruit sellers and they're tailors, but they're earning, we've got an average data point of 108% more than they earned before because of that daycare, because they're not having to take their babies and children to work with them. So they can put their children under 3 into daycare. So they are happy to pay because their own revenue is going up. And then again, all of that child-led data around what are those children weighing, what are they measuring, what are they learning when they're in there? So it's got so many layers of impact, and we really need to show that value, I think.
Maggie, thank you so much for sharing around the work that you do, but also I think reminding us around the vulnerability of children in some of these cycles and some of these crises, but also I think importantly around some of the optionality. So how do we think around diversifying funding models? How do we think around like revolving funds, but also data-driven impact measurements, but also ensuring that we do have human-centered designs and interventions. The chat has been very active, and I think thank you so much to all the participants in the audience that has joined and has been engaging. I would now hand over to Jason. Jason, maybe to pick up on some of the questions that have been addressed in the chat. I think there've been so many, I haven't monitored them as well, but thankfully you are co-convener on the Impact Investing course, and so we can tag team in this regard. So Jason, if you can maybe directly address some of the questions that are in the chat to our esteemed panel. Thanks, Jason.
Thanks, Shaluba. And I think what I'd like to do to maybe aid engagement, yeah, I would like to call on the people who have put the questions in the chat, but also just to stipulate, I think some people asked multiple questions, like 3 or 4. So if you can please choose your most pressing question when I call on you to pose that question, and you can pose it to either individual on the panel or the panel more broadly, but please indicate that as well. So I think the first one that came through in the chat was George Bennett. George, I don't know if you want to unmute and pose your question.
Jason, I'm also happy if you would like to read one of the questions if maybe the audience members are not able to go off mute or yeah.
Okay, so I'm happy to, George posed two questions. One of them was donor networks. Many donor networks are exclusive and operate as silos. What steps can be taken to open the space for program submission and broader consideration, understanding the multidimensional nature of challenges facing Africa and the developing world?
Frank, can I address that to you, given the role you sit at AVPA, and maybe Maggie, given the role your organization plays?
Yeah, so I can totally feel George's sense of saying there's almost a club of donors that operate, and there's exclusivity and what have you. So there's a couple of things in my view. Yes, sometimes donors tend to co-invest with people they're more familiar with, or people they have a more aligned ethos with. But this is also what some of our roles are as ecosystem players. So we are very big on making sure that the partners we work with, for any international partners that we work with, I'm very categorical in asking them, do you have an African partner that you're working with? And if they don't, I don't work with them. So that I'm very clear about, because part of the challenges we've had is not having the opportunity to learn from the best. So even within our catalytic pool fund, we've made space for African foundations to have a seat on the table. Their contribution is less than international foundations, but it's a grant pool fund, because we need to build local capacity. And so we've got to be deliberate and intentional about some of these things. If we're going to be building our own capabilities and stuff. So I think those kind of things are what we need to do. Secondly, I think we've got to be, once again, ecosystem players like us have to be a lot more deliberate about breaking down silos, because silos is not just amongst donors, but it's amongst different capital holders. So when I bring together a grant maker and a private investor, and I tell them, actually, guys, if we work together, we can do more as a collective. Many have never, ever thought of working together as those two extremes. But you demonstrate the additionality that they can bring together in solving a problem, then it totally changes mindsets. So it's work in progress for sure, but it's something we've got to be deliberate in trying to solve for. And then very importantly is, once again, the minute you focus more on initially spending time on making sure that the problem is well understood, as I said earlier, it's so much easier to bring people to collaborate around the problem. So that early stage of your process is super, super important. And don't get tired of talking about the problem. Even when you have a solution, whenever you start a conversation, be very clear of telling people what you're trying to solve for, because that is where the collaboration kicks in.
Maggie, I'm not sure if you had anything further to add in, or if we can maybe go to another question.
Yeah, please go to the other question.
Jason, other questions on the line?
Awesome. Let's try again. Christian, are you there? I see you posed 4 questions in the chat. Maybe if you can share one of those.
Christian, if you are able to hear us, if you can go off mute and maybe just pose one of the 4 questions that you're hoping to get responses from the panel.
Okay, so I'm just going to read out a question. So is it realistic to envision impact investing as a strategic tool for these? As a strategic tool for these are as well, helping them gradually build financial autonomy and reduce dependence on humanitarian and external funding. So I suppose more of just a provocation of saying, like, can we realistically see impact investing playing this way towards financial autonomy?
Shall I have a go at that?
Yeah, please do. Yeah, you did touch a bit on it and how your organization specifically given the beneficiaries that you do support. So yeah, please do go ahead. Basil, I'm also keen if you do want to add to that question, if you do want to then jump on, also given the importance of blended finance within the current context.
Okay, so what my take on this is we do have to be realistic. Again, people keep quoting like the trillions that are available, which is exciting. But I also think that what we talk about a lot is blended, and we talk about lowering the cost base rather than profitable, because we particularly are definitely impact first, right? We're looking for impact first, return second. So therefore, these are seen as high risk borrowers. Our 97% repayment rate on our debt products and our loans shows that they are not a risky borrower, but the perceived risk is always way higher than the actual risk, right? So then the other thing I'd say is that the impact investment that's flooding onto the continent, there is some coming in infrastructure, in climate, but in things like health and in education, again, much less so, because these are seen as risky areas. And a lot of the impact investment, honestly, that's coming on is not expecting a concessionary rate of return. It's often a commercial rate of return, which perhaps isn't realistic because, you know, a woman setting up a chain of low-cost ECDs, she probably doesn't need an equity product. That's probably going to break her, but she does need a concessional loan. And you can still cover your costs with that if you put a decent interest rate on it that is fair. And it's sort of win-win, in fact, because it's particularly win-win, I can only say from our point of view, because we would have just been paying one way for something like that and nothing would have been returning. But now this is a way of, again, lowering the cost of programming or blending the finance. Hopefully then the next person who comes along, our borrower will be slightly more commercially minded. They've had some experience with us. Through our technical assistance, we've also then built up their ability to pitch, their marketing, their financial their marketing strategy, etc., and their financial modeling. So yeah, I do think it's a realistic strategy to answer the question. I just think it's super important to know which bit in particular you're getting into and then have realistic goals around that.
Thank you so much for sharing on that, Maggie. Basil, maybe to rephrase the question, you are based in Kenya, you are Kenyan. We are doing the Impact Investing in Africa course in Kenya in July. And I'm really curious to understand what must national ecosystems put in place to attract and retain long-term impact capital? And how well are we doing across markets such as Kenya? And what should we replicate at scale continent-wide?
Yeah, sure. That feels like 3 questions in one.
Sorry about that.
Yeah,
Yeah,
sure. So I guess from basically looking at national ecosystems, you know, like what must we put in place to attract and retain long-term capital, long-term impact capital? I think broadly speaking, there's already, you know, evidence around various initiatives that have been basically that were set up by donor financing, but have already significantly proven viability, commercial viability in and of themselves. Perhaps I'll focus on the agri-SME space. You know, select a random agri-SME anywhere in Kenya and perhaps walk with them to a bank, you know, to seek a loan facility. The first question that the loan officer will ask for is, you know, what collateral are you providing for this loan facility that you want to take out? And most of these agri-SMEs, you know, primarily as they are starting off, they will most likely be, you know, have been depending on working capital. And if they are looking to perhaps scale their operations, which requires a bit of CapEx undertakings, that then becomes a barrier because they don't have sufficient collateral to then, you know, provide in exchange for the facility that they want to take out. And there's already multiple examples that have shown that in such instances when a guarantee is provided for such agri-SMEs to enable them to take out a facility, then the delinquency rate has basically been proven to be single digits, and even in some cases below 5%. And you know, there's been various organizations which have been piloting this model. There's one in Uganda called ABI Finance. There's one in Tanzania called Pass Trust. Both were set up by Danida. I mentioned Asili Africa earlier, you know, set up with donor financing. There's the African Guarantee Fund, again, sort of set up with donor financing. So all of this, you know, organizations have basically proven that over time, supporting these agri-SMEs has resulted in single-digit delinquency rates, which basically means that, you know, such sectors are bankable. And so I think more broadly, in terms of looking at what can we do at the national level, it's basically looking at what policy interventions are required to sort of enable the, you know, this evidence that has been proven over time to sort of be embedded into the business models of financial intermediaries. And there's sufficient examples from other jurisdictions. A good example is India and even Pakistan, where basically the government has a policy requirement that a certain percentage of the banks, you know, lending must go to specific sectors, and key of those is agriculture, which obviously is a key, you know, sector within the economy. So I think basically looking at where do you have already sufficient evidence that shows bankability of certain sectors which are key for the economy, and how do we then take up that evidence and embed it into policy interventions that ultimately enables the scalability of, you know, flow of financing to these sectors. So I think that more broadly is you know, what I'd offer as a recommendation to, you know, helping embedding long-term impact capital within the national ecosystem.
Okay, and thank you very much for that, Basil. I think what is important in this conversation is really moving to more solutions-driven ideas, suggestions, and almost treating this as some form of ideathon. And so I think, you know, some of those recommendations really important. Frank, I see you've come off mute. I don't know if you wanted to add to some of the points that Basil has inputted. We will be taking 2 or 3 more questions, and then we'll also get closing remarks from the panel speakers. Jason, 3 more questions from the audience.
I want to see if Tasha, you're there. I think you had a few questions around outcomes and measurements. Do you want to maybe do questions? Yeah. Go ahead.
I am here.
Yeah,
I think Maggie and Frank largely answered my questions. I'm really interested in this question of measurements. And I think some outcomes are easier to measure than others. And how do we make sure that we don't leave really important outcomes that are more difficult to measure behind? So something that I'm thinking about is, you know, it's really important to provide, say, a medical service or a health service for a child, or the example that Maggie gave around childcare for refugees is really important. And it's relatively easy to measure that in terms of numbers of people that take it up. But what about projects that are sort of maybe more in the creative space that increase cohorts of young people's confidence, or increase something like hope and agency among a group of young people that are sort of less on the basic needs of what people need, but still really important? And how do we make sure that those things don't get left behind in this funding crisis? Frank, I heard your comments. I think, Maggie, you partially addressed that, but then combined with Frank's comments about how there's still a place for philanthropy, and maybe philanthropy fills those gaps. But I'd still be really interested to hear about that. And then also some of the intricacies of measurements of social impact bonds, because from what I've read, it's quite challenging. And some of the bonds that have been implemented in South Africa, it was actually really hard to measure the impacts and prove return on investments. So it would be really interesting to hear about some of that. Thanks.
Thanks, Tasha, for those really great questions. Maggie and Frank, I think Tasha did call on the both of you, so I think any of you can please go ahead.
Maggie, do you want to go first?
Frank, go for it. You're off mic.
All right, cool. So you're very right. The whole issue of impact measurement is a challenge. And what we have to be deliberate about, and why, especially in blended finance structures, or where philanthropy comes in as catalytic investments in these deals, tries to ensure is we're not just measuring financial returns, but also measuring impact progress. What's most important in this space is not to necessarily do too much or do everything to the deepest level possible. I think is to pick the few most important things that you want to track, and that you believe you can do well. They could even be proxy metrics, for example. I had someone who, for example, was trying to track the impact of month-end spending or trade in rural areas, and they want to show how to best track when people are getting together in markets to trade. And you know what they ended up using? Were heat maps, Google heat maps of cell phones. Okay, the same ones we use for in GPSs, and we're able to tell when those heat maps were much bigger and much more active. And with that, then they could go and do some surveys in those marketplaces, because what they wanted was data on trading practices of smallholder communities or communities in rural areas. And they just used heat maps. So sometimes the solutions we need to use are not very obvious. But you're better off measuring a few things than measuring nothing at all. And you're better off measuring a proxy of a data piece that you're trying to chase than the deep data item that you're trying to track. So it's not a perfect answer, but in essence, what I'm saying, measure something rather than not measure at all.
Thank you so much, Frank. Maggie, I see you've come up to me.
Yeah, I would just add to that by saying that we don't need to measure everything ourselves, right? We can partner with people who are very good at measuring one particular thing or the other. So like when we're doing climate stuff, let's say, we sometimes wrap ourselves in circles being like, in which sort of ways are we going to say that this business, which clearly has an impact on climate, perhaps they're an agribusiness, and we've established they've got an impact on climate, and then we're trying to find a link to the child lens piece, right? But actually other people have done that macro level research on how the climate crisis is greatly affecting children. So the children's probably done it themselves, like, you know, at a different level. It doesn't need to be my team that are measuring that type of impact. So I think on the qualitative data piece, which Tasha, you particularly mentioned, I think, yeah, partnering, like who's already doing really good impact measurement in that qualitative space, and can we partner with them? And actually another reason why I've been trying to Save the Children in this direction is because we do have great impact measurement teams, right? We know how to measure impact on children in really messy, moving environments. So actually the impact measurement piece, I think, is one of our strengths. There's other pieces that we need to learn from. We need to build up our skills, incidentally, in due diligence, for example, financial management, things like that. But the impact measurement piece, you know, a lot of our NGOs are in a really good space for that.
Thank you so much.
So just to say briefly on social impact bonds, that's super interesting. I'd love to hear what other people have got to say on it. But for me also, they're only one innovative finance mechanism. They are definitely not the be all and end all. And I've seen also they can be so laden with different bureaucracies and different partners needing, but you know, sometimes it works well, particularly at scale. But sometimes when you have factored in all of the effort, it can be just as good to use another form of innovative finance. So it's not the only game in town, social impact bonds.
I completely agree with that statement, Maggie. Is definitely social impact bonds are not the only innovative instruments available. I think Jason is going to talk to it in more detail, but on the Impact Investing in Africa course, we actually have about, I think, a 4-hour session around innovative finance where we cover 25 instruments. And so social impact bonds being just one of them. And so we would really implore people who are keen and interested in learning more. We speak about recoverable grants, forgivable loans, and all sorts of mechanisms and instruments. We also go into a lot more detail around blended finance. And so, yeah, I think definitely I would encourage, Jason is going to spend at least 5 to 10 minutes at the end of this masterclass just sharing more around the Impact Investing in Africa course, because I think even from some of the conversations and chats, people are saying they're wanting to learn more. And I am also seeing, you know, some really nice connections and partnerships where people are engaging the panelists directly. So I think it's been a really great space to start exploring collaborations going forward. Jason, I don't know if you want to take 1 or 2 more questions. I'll leave that in your capable hands.
I think I'm happy for us to open the floor to 1 more question. So just putting it out there, if you are wanting to ask a question, please do raise your hand. We would love
I'd like to quickly ask a question if I can.
Please
Yes.
go ahead, fastest finger first.
Yes. I was like, I can't even figure out how to raise my hand. I'm just going to turn my camera on.
Go ahead.
Thank you so much for you all's time. So I did pose a question to Frank. You mentioned changing people's mindsets, and I did share a quote in the chat that just discusses or states rather, every system is perfectly designed to get the results that it gets. And so, Frank, any advice, tips on how do we effectively encourage people to change their mind and it not just be a first order change of we're just dibbling and dabbling and tweaking the system here or there, but it's actually a disruptive, chaotic, and a healthy way change to a system that has not been functional for decades?
Yeah. So very quickly, Julian, that's a good question. So I will come back to what I've just mentioned. Is first of all, meet people where they're at, and you meet people where they're at. Where people will pay most attention to you is when they see you got an interest in solving their problems. Like people come to us, investors come to AVPA because they've got problems they believe we can solve for them. So that's the starting point. And then spend enough time to make sure that you both align on what problem it is you're trying to solve for. And then secondly, the opportunity cost of that problem persisting. Okay, if we don't do anything differently, what will happen? What's the opportunity cost? Like now, if I look at like the question of our biggest problem in Africa, for example, one of the biggest is youth unemployment. Every hour, we have 1,000 young Africans becoming unemployed. Every single hour, okay? When you put it that way, and then I tell people like the opportunity cost of these guys is we might as well go across the continent every single hour, close down a primary school of 1,000 kids. Then the message starts hitting home because those kids have no future. We might as well tell them go home. And it's so you've got to be very good at how you position your data and facts and how you tell your story. But I think people have to know that you care about them, that you really care about the problem they're trying to solve, and then they'll handhold you in co-creating a solution. Okay, so if you just too many times we go in and just want to sell our solutions, not caring what the problem they're trying to solve, and that's a mistake we make. Okay, the starting point is to totally align the problem you're trying to solve with the people you're trying to solve for, and then be very clear on the opportunity cost because it creates a sense of urgency, and then you can talk about the solution that you want to put forward.
Frank, thank you so much for that input and response. And Trillian, thank you so much for jumping on, but also sharing that really great question to the panel. I think we can maybe take closing statements or closing sentiments, anything the panelists would really like us to take away with. Basil, I'll start with you. You have mentioned the fact that the State of Blended Finance report is out. The Convergence team is open to feedback and input on that report, but anything else that's really urgent, important, that you're keen to share, please do go ahead. Jason, I'm not sure if that's a hand.
No, just a clapping for the report.
Okay. Thanks. But if we can please take closing statements from the panelists. Basil, I'll start with you.
Yeah, sure. Thanks, Chiluba. And thanks, Jason, for the accolades. So I think for us at this point in time, cannot be overstated that this is a rightly timed conversation. And I think it's important to sort of look inwards and see, where have we generated evidence so far of the efficacy of blended finance, and how then can we sort of internalize these solutions and have them to be locally led, or led by local entities, and that again is a key focus point of the report that just came out yesterday, basically looking at how can domestic capital play a significant role in mobilizing private capital going forward. Thank you.
Basil, thank you so much for that. Maggie, if I can please come to you to share closing statements, sentiments, call to action, anything that you really want the audience to take away from this very important and timely conversation.
Thank you so much. And thank you truly for convening us at this time. Like, it couldn't have come at a better time, I think. So I would just end with saying that this disruption in traditional aid is a wake-up call, and it's an opportunity. And by embracing enterprise, innovation, and African-led investment models, we really can build resilient systems that deliver, for our part, for children and for communities, regardless of the external shocks that might come. So this time it's been USG funding that shocked the sector, but it might be, and COVID before, there's going to be many shocks, but I really believe that we can build something that is resilient to those. The future of impact investing in Africa definitely lies in partnership, in local leadership, and in a relentless focus on sustainable, measurable outcomes that are linked to evidence and data. And then I'll just end with saying that if anyone wants to know more about child lens investing, then we're going to be doing a session on this during the upcoming impact investment course that you mentioned earlier, that yourselves and Bertha are running. So yeah, thank you for having me on this.
Thank you so much, Maggie, for your participation. Frank, if I can maybe come to you. You spoke earlier around learning to do more with less, but I don't know if there are any other really strong sentiments that you want the audience to take away.
Yeah, thank you, Shiluba, Jason, for organizing this. Really appreciate it. And to my fellow panelists, thank you for your really insightful contribution. We have to prepare Africa for an aid-free future. Let's not try to think, let's not sit here and think it might come back, partially might not. I think if it ever comes back, it should find us in a state of independence and resilience. We've got to start thinking about what it will take for us to be a self-sustaining continent going forward. And we can do that. We've got the resources that we have locally. As I mentioned to you, there is private capital on the continent. How do we bring it to the impact space? It will take a few painful decisions. It will take a lot of innovation and experimentation, some failures, many of which I'm sure will be failing forward. But no one's going to come and solve these problems for us. Let's get that very clear. Our problems are for us to solve, and we can't be left vulnerable to geopolitics going forward. So we've got to prepare Africa and future-proof ourselves against this kind of shocks going forward. But I would strongly recommend we prepare for an aid-free world, and let's build more sustainable solutions for the continent.
Thank you so much, Frank. Completely agree with those sentiments. Please do not jump off. I think a plea to audience members. I think as we bring this masterclass to an end today, I'd like to once again extend our hearty thanks and gratitude to the panelists. I think your contributions, your insights, your realities have been really helpful to this conversation. These really honest reflections will definitely move the ecosystem forward. I think what is also key is looking at, Frank, I think you spoke around the call to unlock local capital and ensuring that as a continent we can become self-sustaining. Maggie, you spoke around this being a really great wake-up call for all of us in the sector. But really, I think a reminder around the importance that when old models collapse, we need to reimagine new ones. And Basil, I think important really having your voice and contribution around what is possible with blended finance when deployed with intentionality. And so I think what we're getting definitely from today's conversation is the era of waiting is over. The mandate now is to lead. And so with this, there is a key and important moment for action. And so if today's conversation did stir something in you, be it an idea, a commitment, or a provocation, we really invite you to deepen the journey, and potentially through the Impact Investing in Africa executive program hosted by the University of Cape Town's Bertha Centre. It will be taking place in July in Nairobi and then September in Cape Town. And so I would now like to hand over to Jason to maybe just share a bit more around the Impact Investing course that will be taking place both in Nairobi in July, but also in Cape Town in September. And I know Maggie and Frank will be participating. We always have conversions in the room as well. And so, yeah, Jason, maybe over to you to share more around the course.
Thanks, Shaluba. And just like a quick one, just to say, like, so much appreciation to the panelists, but also to you, Shaluba. I think you did an incredible job moderating and facilitating the conversation. I think it's been really insightful, and I've learned a lot as well from the conversation. And yeah, so just to the audience as well, thank you so much for joining. Thank you for your contributions. And so we've spoken a lot about the Impact Invest in Africa course, because it is really an important course on the continent to start both equipping people who are on the continent to have that leadership we're talking about to drive impact investing on the continent. So we've been running the course for over 8 years now. Last year was the first time that we ran it outside of Cape Town, and we then ran it in Nairobi, Kenya, which was incredible to do it there. And so this year we're planning to do it in Nairobi as well on the 28th of July to the 1st of August. And then we're doing it in Cape Town as well, the 8th of September to the 12th of September. So really do encourage you, please have a look, apply. We cover a whole lot of different aspects of impact investing, both from innovative finance, so social impact bonds, outcomes-based contracting, blended finance. We speak about impact measurements and management as well. We have a whole day dedicated to that. We also look at the landscape. We look at what are some of the trends, the emerging trends, some of the technologies to look out for as well that is impacting how investments and how assets are allocated. There's a whole lot of things which pack into a week. But one of the biggest things is the ability to connect with speakers such as Frank, Maggie, and Basil on the course. We have networking opportunities. We have incredible delegates, some which actually joined the webinar today. So also a big hi to them, and yeah, a credible alumni group so that you don't have to walk this journey alone. It's all about kind of coming together and collaborating together. So again, really looking forward to that. And again, thanks so much for joining us today. And thank you so much, panelists.
Thank you so much, Jason, for just sharing around the overview of the course. I think important is let's continue to question boldly and build collectively. I think Trillian, you put in the chat, putting our hands to the plow will be important in this moment. And I think thank you for all your presence, for the engagement, both from a panelist perspective with their great and deep insights, but also from the audience with all the questions and engagements that we've seen in the chat. And your commitment to funding what matters is really important, especially when it matters the most in this moment now. And so we will then be bidding you all a fond farewell and look forward to engaging with you in future.